In the late 2000s, several factors, including the financial crisis and the UBS scandal, brought the topic of tax avoidance by US persons to the attention of the US Congress and eventually resulted in the enactment of the Foreign Account Tax Compliance Act, for short FATCA, in 2010. The goal of FATCA is to prevent US persons from avoiding tax by earning income on foreign investments or assets held in foreign bank accounts which are not reported to the IRS. FATCA operates by imposing identification, documentation, and reporting obligations on so-called foreign financial institutions, or FFIs, which generally include most non-US banks, custodians, some insurance companies, and most investment funds, as well as their managers and advisors. FATCA attempts to identify both historical and current tax avoidance through various due diligence procedures. For example, funds that existed prior to 1st of July 2014 were required to conduct reviews of their existing investors in an effort to identify investors that may not have previously documented themselves as US persons. For the purposes of this video, we'll focus on the obligations of the funds to prevent future tax avoidance by identifying new investors into existing or newly formed funds. As of July 2014, FFIs are required to obtain certain documentation from new investors in order to determine if the new investors are US or non-US persons. The documentation required varies depending on the jurisdiction of the FFI, but generally it will require that the investor complete a self-certification form in addition to providing the necessary identification documents, e.g. passport, residence permit, etc., as required under the local AML or KYC rules. Such a certification can be designed by the FFI itself. They will generally ask for information such as the name and address of the investor, tax residency of the investor, but also may include specific questions regarding the potential US status of the investor. If the FFI does permit US investors, then the FFI will be required to submit an annual report to the US Tax Authority, the IRS, that includes information about each investor, such as their name, address, income earned, investment or account balance, etc. Depending on the jurisdiction of the FFI, the submission of the report to the IRS may be done directly to them or may be done through the local tax authority. As a final obligation, an FFI may be required to withhold tax from certain US source payments received by investors if the investors have not provided the documentation required by the FFI. In practice, this is rarely seen, as most FFIs will not permit persons that have not provided the required documentation to make the investment in the first place. So what does this mean for you as an investor in a fund? If you're a US person and would like to invest in a non-US fund, you can expect to provide an IRS form, like a W-9, and to have your personal information, as well as information about your investment, reported annually to the IRS. If you are not a US person, then you might expect to have to complete a self-certification form upon account opening to confirm that you are not a US person, and then FATCA will have no further impact. Basically, if you're not a US person, you will not be reported to the IRS. However, as a non-US person, you may be subject to the Common Reporting Standard, also known as the Automatic Exchange of Information. And guess what? It's kind of similar to FATCA.